Here's the reality. The average American overpays for car insurance by $634 every single year. That's $634 you could put toward literally anything else. Yet 73% of drivers never shop around or review their coverage. The worst part? Many are paying for protection they don't need while leaving dangerous gaps that could cost them $50,000 or more in liability. In this complete 2026 car insurance guide, I'm breaking down exactly what you need, what you're wasting money on, and 3 specific strategies that could cut your premiums in half. By the end of this video, you'll know more than 90% of drivers about how insurance actually works and what's driving your costs up. Let's jump in. Most people hate their insurance bill, but have no idea why it's so high. They just pay it. Let me show you exactly what's happening. Your insurance premium is calculated on 12 different data points, and insurance companies are ruthlessly efficient at finding ways to charge you more. First, your driving record. One at-fault accident increases your rates by 30 to 40% for 3 years. A speeding ticket? That's 10 to 15% immediately. Second, your location. Someone in rural Montana pays $1,200 annually, while someone in Miami pays $2,800 for identical coverage. Why? Theft and accident rates. Third, your vehicle. A 2024 Honda Civic costs less to insure than a 2024 Dodge Charger because repair costs differ. Fourth, how you use it. Commuting 40 miles daily versus 5 miles costs more. But here's what matters. These 4 factors alone control 70% of your cost, and 3 of them are either fixed or difficult to change. So where's the real money leaking? In coverage you don't need and discount thresholds you're missing. The average person is either overinsured on optional coverage or underinsured on liability, sometimes both simultaneously. Car insurance has 4 coverage types, and understanding the difference between them will save you hundreds. Let's be precise. Liability coverage is what's legally mandated in 49 states. This protects the other person if you cause an accident. It has 2 numbers: bodily injury and property damage. Texas and New Hampshire are the only states without mandatory liability, but lenders require it anyway. The minimum is usually $25-50-25, meaning $25,000 per person, $50,000 per accident for injuries, and $25,000 for property damage. Here's the problem. Those minimums are dangerously low. If you hit someone and cause serious injury, medical bills easily exceed $100,000. That's your personal liability. I recommend $100, $300, $100 minimum, which costs about $15 more monthly. Collision coverage pays for damage to your car when you hit something, another vehicle, a tree, a guardrail. This is not legally required, but lenders mandate it if you're financing. It typically has a deductible of $500 to $1,000. Comprehensive coverage pays for non-collision damage, theft, weather, vandalism, wildlife. Same deductible structure. Uninsured, underinsured motorist coverage protects you when the other driver either has no insurance or insufficient coverage. This is the coverage that saves you from financial ruin if someone else causes the accident. I see people skip this and immediately regret it. You want this equal to your liability limits. The deductible is where most people make terrible decisions. Let me show you the actual math. A deductible is the amount you pay out of pocket before insurance covers the rest. A $500 deductible versus $1,000 deductible typically saves $15 to $25 monthly on comprehensive and collision combined. That's $180 to $300 annually. Now here's where people go wrong. They choose $1,000 or $1,500 deductibles to save money without calculating if they can actually afford it. If you get in an accident and don't have $1,500 in emergency savings, you're now stuck with debt or driving an unrepaired vehicle. The math that matters is this. If you have 0 emergency fund, a $500 deductible makes sense even if it costs more monthly. If you have $3,000 in savings, a $1,000 deductible is usually optimal. The break-even point is simple. Annual savings times years to break even should be less than your safety margin. Example, if a $1,000 deductible saves you $240 yearly versus a $500 deductible, you break even in about 2.5 years. If you plan to keep the car that long, it's mathematically worth it. But there's a hidden strategy. Most accidents in your lifetime will be minor. You'll never claim them because the damage is under your deductible anyway. This means a higher deductible often doesn't increase your out-of-pocket risk. It decreases it because you're less likely to file claims and face future rate increases. Here's the legal requirement puzzle. Car insurance rules vary dramatically by state, and insurance companies rely on you not knowing your state's exact rules. Let me map the 7 biggest legal requirements in 2026. First, minimum liability coverage varies. Most states require 25-50-25, but Florida requires 10-20-10, while Virginia allows you to post a bond instead of buying insurance entirely. Second, some states require uninsured motorist coverage by law. Michigan, New York, New Jersey, Kentucky, and Pennsylvania mandate it. Third, bodily injury protection is required in no-fault states like Michigan, Florida, and New York. This pays your own medical bills regardless of fault. Fourth, PIP, personal injury protection, is mandatory in some states and optional in others. It covers lost wages and medical expenses. Fifth, property damage liability is required separately in every state, and the minimums vary from $10,000 to $100,000 depending on state. Sixth, some states require you to maintain continuous coverage or face license suspension. A lapse of even 30 days can get you labeled a high-risk driver, permanently increasing rates. Seventh, many states now require you to prove you have insurance before getting your license renewed. You literally cannot update your license without proof of active insurance. The action item: Google your state plus minimum car insurance requirements 2026. Spend 10 minutes reading your state's DMV website. I guarantee you'll find something you're either overinsured or underinsured on. Then call your agent and adjust. This is where insurance companies make their real money. Premium hacks that sound too good to be true but are absolutely real. Hack number 1. Bundling. If you bundle car insurance with home or renter's insurance, you get 15 to 25% off both. This is the single largest discount available, and almost nobody takes it. If you have renter's insurance at a different company, switching both to one carrier immediately saves $300 annually. Hack number 2. The loyalty discount. After 3 years with the same company, you're eligible for a loyalty discount of 5 to 10%, but you have to ask. Insurance companies won't advertise this because they know you won't ask. Call your agent directly. Hack number 3. Safety features. New cars with anti-theft systems, automatic emergency braking, and lane-keeping assistance get 5 to 10% discounts. Some insurers give this automatically. Others require you to ask. Hack number 4. Good student discount. Maintained a 3.5 GPA? You get 3 to 5% off until age 25. This applies even if you're not on your parents' policy. Hack number 5. Defensive driving certification. A 2-hour online course costs $15 to $30 and nets you a 10% discount for 3 years. That's essentially free money. Hack number 6. Usage-based insurance. Apps that track your driving patterns give 10 to 30% discounts if you drive safely. Most people think this is invasive and skip it, but if you drive cautiously, it's literally money on the table. Hack number 7. Paying in full. Monthly payments have a processing fee of 3 to 5%, while annual payments don't. If you can afford it, paying once yearly saves $50 to $100 immediately. The strategy: implement 4 of these and you've reduced your premium by 35 to 50%. Insurance companies deny claims for very specific reasons, and understanding these reasons might save you massive stress later. Reason number 1. Material misrepresentation. If you told your insurer you drive 5 miles to work but actually drive 50 miles and you get in an accident, they can deny the entire claim. They investigate before paying large claims. Reason number 2. Policy lapse. If your payment was even 1 day late and your policy wasn't in effect during the accident, zero coverage applies. Reason number 3. Exclusions you missed. You thought you had coverage for a teenage driver, but your policy specifically excluded drivers under 25. This is hidden in the fine print. Reason number 4. Driving under the influence. Absolutely zero coverage if you're impaired. Reason number 5. Using your vehicle for commercial purposes. If you were doing DoorDash or Uber when you got in an accident, but your policy is personal use only, they deny it. Many gig workers don't realize this. Reason number 6. Using your vehicle for a purpose excluded in your policy, like racing. Reason number 7. The accident was intentional. This sounds obvious, but people have tried to commit insurance fraud. Here's the key. Read your policy's exclusions section. It's usually on pages 6 to 9 and nobody reads it. Specifically check who's covered to drive, what purposes are covered, what vehicles are covered, and what situations void coverage. 1 hour reading your policy prevents catastrophic surprises later. Here's your action plan for the next 7 days. Day 1. Determine your state's minimum coverage requirements. Go to your state's DMV website right now and spend 10 minutes. Write down your state's bodily injury minimum, property damage minimum, and whether uninsured motorist is required. Day 2. Review your current policy. Find your declarations page. It's the first page. Write down your coverage limits. Are they at state minimums or higher? Day 3. Calculate your emergency savings. Do you have enough to cover your deductible? If not, adjust it downward. Day 4. Implement the hacks. Check eligibility for bundle discounts, good student discounts, safety feature discounts, and usage-based insurance. Day 5. Get 3 quotes. Use at least one online aggregator like the Zebra or NerdWallet, plus direct quotes from Geico and State Farm. Don't trust one quote. Day 6. Review exclusions. Read pages 6 to 9 of your policy. Specifically note if teenage drivers or commercial use are excluded. Day 7. Make the switch or adjust. If another company saves you $30 monthly, switch. If your current company can match it with discounts, stay and ask for them in writing. Next week, we're covering the complete guide to homeowners insurance, the 12 mistakes that leave homeowners unprotected and costing thousands. Hit subscribe so you don't miss it. What's your biggest car insurance frustration? Comment below and I'll address it in next week's Q&A video. Thanks for watching.